What do the recent US interest rate cuts, the talk of reducing tariffs, and Warren Buffett finally buying stocks all mean when they happen at the same time? On the surface, it looks like the party for big money is just getting started. Without the threat of tariffs, it seems the US stock market doesn't have to worry about a crash, and some analysts believe its value could even double this year. And when the cost of doing business is pushed down by lower interest rates, it feels like everyone is positioned to make more money than ever before. To top it all off, even Warren Buffett, who has been selling stocks and sitting on a mountain of cash for years, appears to be buying the dip, preparing for his next big move. So does this mean ordinary people can just start copying what Warren Buffett is buying? Have we finally reached the next great opportunity to get rich? The first one this big since the 2008 financial crisis? Is that really the case? I have to laugh. Hello everyone, welcome to Stewardship Finance Academy. In economics, there's a concept often called the Economic Trilemma. It's simple, really. The US is currently juggling three things: its national debt, inflation, and trade tariffs. So the hard truth is, it can likely only control two of these at once. One has to be sacrificed. For example, if the US imposes high tariffs while also lowering interest rates, the consequence is that inflation will be sacrificed. Prices would likely soar, leaving ordinary Americans to foot the bill. Think of it this way. Lowering interest rates makes it cheaper to borrow money. When everyone borrows, the money supply increases, and more money in circulation means each dollar is worth less. If you add tariffs on top of that, everything the US buys from around the world gets more expensive. Naturally, prices rise. The hard-earned money of ordinary people gets devalued without them doing a thing. This is sometimes called a tax on the poor. In this scenario, lowering rates and keeping tariffs protects the interests of big capital and the government, but at the expense of the average person. That's the first option. However, if you want to protect average people and the government, you could sacrifice the interests of the capitalists. In that case, the US could keep the high tariffs and control inflation, but it would have to raise interest rates. This would make borrowing more expensive for both individuals and corporations, which would almost certainly lead to a sharp decline in US stocks and bonds. That's the second option. The third option is to protect both the capitalists and the average person. This means lowering interest rates to stimulate the market while also pushing down prices. To do that, the government would have to abandon tariffs completely, which could be seen as a major policy failure. It's clear which path is being taken. Interest rates were cut a few days ago, which means sacrificing the interests of large investors is off the table. That leaves a choice between tariffs and inflation. Do you think the US government will sacrifice its own interests and cancel all its tariff agreements just to make things cheaper for everyone? The answer, surprisingly, might be yes, because it may not be the government's choice to make. Many analysts point to US tariffs as the root cause of the stock market downturn in April of this year. Now, US courts have reportedly ruled that these tariffs may be illegal. Why? Because tariffs are a form of tax. And in the US system, the power to tax doesn't belong to the president. It belongs to Congress. For this reason, court has apparently set a deadline of October 14th. If that deadline passes, without an objection from the Supreme Court, all the tariffs the US government imposed could be overturned. The result would be a scenario where interest rates are cut, inflation is kept in check, and the interests of both capitalists and the public are protected. The ultimate sacrifice, the tariffs, and with them, the government's policy. Because of this, it seems the worst is over. Warren Buffett, with his huge cash pile, is buying the dip. It seems like we can all start investing without a second thought. But is it really that simple? Let's be clear. Warren Buffett did buy stocks. His firm even requested confidential treatment from the SEC to keep the purchases secret, which made everyone think he was making a massive move to buy the dip. But the real question is, how much did he spend? Only about $5 billion. To put that in perspective, Warren Buffett's company earns over $15 billion a year from interest alone, without doing anything. So, we're being told that he used just a tiny fraction of his passive income to buy some assets. And we're supposed to conclude he's going Elon on a bargain hunt? If he had $350 billion in cash and invested $100 billion, or even $50 billion, I'd believe he was bargain hunting. But $5 billion? It seems almost insignificant. Most importantly, while he bought $5 billion worth of one stock, he also sold $8 billion worth of other stocks, including Apple. In other words, Warren Buffett is still a net seller of stocks. What if I told you that Warren Buffett is acting like a magician? With his left hand, he's making a small, flashy purchase to grab everyone's attention. But with his right hand, he's quietly moving his major assets out the back door. What would you think? What if I told you that the interest rate cuts aren't actually protecting the interests of capitalists, but are starting to harm them? And what if I told you that the tariffs must not be abolished because doing so could trigger another financial crisis? What would you think if all three of these things were happening right now? I'm telling you, in this economic trilemma, the interests of the average person are almost always the ones that get sacrificed. If you don't want to be a victim, and maybe even hope to use this situation to improve your financial standing, you should subscribe to my channel for more information. If you're worried you'll forget what you've learned, you can like this video, and it will be saved to your playlist, so you can review it anytime. First, let's get one thing straight. The Federal Reserve's interest rate cut itself isn't the most important detail. What matters is why and how it's being done. There are two types of rate cuts: preventative and recovery. A preventative cut is like a healthy person taking vitamins to stay well. The economy is doing okay, and the Fed is just giving it a small boost to prevent a future downturn. Well, this kind of cut can be done slowly because there's no immediate danger. A recovery cut, on the other hand, is like a doctor giving powerful drugs to a seriously ill patient. It means the economy is likely already in a recession, the country is losing money, and people are losing their jobs. The Fed is forced to cut rates quickly and dramatically, sometimes even resorting to printing money to buy up assets on the verge of collapse. So which one is the Federal Reserve doing now? It looks like a preventative cut, right? The cut was very small, only 0.25%. And the forecast they released suggests they'll only cut rates twice this year, and maybe once next year. It seems they're not in a hurry. They're just preparing for a rainy day. Or are they? Let's look at the US GDP. At first glance, the data is beautiful. 3.3% growth. That suggests a very strong economy. But when you look closer at the components of that number, a more troubling picture emerges. To understand the US economy, you have to look at consumption, which makes up over 60% of its activity. And we can clearly see that between the first and second quarters of this year, American spending has decreased significantly compared to previous years. So if consumption is down, how's GDP still so high? It's simple. One figure went up. That figure is net exports, which is driven by a reduction in imports. What does that mean? Imports represent the US spending money on goods from around the world. In accounting terms, imports are subtracted from GDP. So if you import less, you're subtracting a smaller number, which makes the final GDP figure look bigger. The US appears richer because it's spending less money. But at the same time, its main economic engine, consumer spending, is slowing down. It's like saying you've become wealthier because you've stopped buying things, even if your income also went down. Does that really mean your standard of living has improved? No. The data shows that Americans' ability to spend and earn has actually gotten worse since interest rates were cut, not better. And why are Americans spending less? It's not because they're suddenly saving more, it's because they can't afford to spend. After the tariffs, goods from around the world became more expensive. So this reduction in imports doesn't mean Americans are being frugal. It means they're being priced out of the market, since so much of what Americans use every day is imported and local goods are also expensive. How can we say the economy is improving? Now look at the first quarter GDP. It was minus 0.5%. The beginning of the year, when the government announced plans to increase tariffs, businesses went on a shopping spree to stockpile goods. Imports shot up, which is a negative for GDP. But at the same time, inventories, the goods they stored, went up, which is a positive for GDP, offsetting some of the drop. The main reason GDP fell into negative territory was that consumption had already shrunk. People had stopped spending. If you average the GDP for the first and second quarters, you get only 1.4%. Is it possible the US economy is like a patient with a serious illness, and the government's talk of rate cuts is actually a sign of a necessary recovery cut? The Federal Reserve is playing it cool, making a small cut and calling it preventative, but that's a serious problem. For rate cuts to work, businesses and individuals need to have confidence in the future. But with the ongoing trade disputes, who dares to invest? A business owner would rather put their money in US Treasury bonds and earn a safe 5% than risk expanding. Even worse, years of high interest rates have created a class of wealthy individuals who live off the interest from their capital. Think of Warren Buffett, who sold stocks to buy short-term bonds. When you cut interest rates, you directly hit their income. This is why the dollar often falls when rates are cut. Capital flows out of the US to other countries where it can earn a better return, which reduces the amount of money in the US market and cancels out the benefit of the rate cut. Is slow. Gradual cuts can be the same as no cut at all. This is exactly what happened before the dot-com bubble burst in 2000 and the financial crisis. In 2008, the Fed started with small preemptive rate cuts, and the market crashed anyway. Every market crash is a moment of wealth redistribution. In 2008, some people went bankrupt, while others bought the dip and became incredibly wealthy. In 2020, many retail investors lost everything, while some hedge funds tripled their profits. This year's crisis could be the last chance for ordinary people to change their financial destiny. The reason so many people lose money is that they either blindly buy the dip and get stuck, or they panic sell at the bottom. You must learn to identify the signals to sell before a crash to lock in profits, and how to capitalize on the reversal. We just need one system that works. We've documented this system in our stock investment masterclass, which we are offering completely free to our subscribers. Check out the link in description. You might think I'm making a big deal out of the GDP data, But let me show you another number. The unemployment rate. It's only increased from 4% to 4.3% this year, which doesn't seem too serious. But what if we look at the non-farm payroll data? This month, the US revised this year's non-farm payroll data down by 910,000 jobs. That means nearly 1 million jobs that we thought were created this year never actually existed. It's like you got a 100 on an exam and then your teacher told you it was a mistake and your real score was a 9. Even more shocking, the jobs number for June was revised from plus 147,000 to minus 13,000. When the employment data is negative, it means the US isn't adding jobs, it's cutting them. Imagine 147,000 people quit their jobs, expecting to find new ones, only to discover that companies actually laid off another 13,000 people. That would mean 160,000 people are suddenly unemployed, which should cause the unemployment rate to skyrocket. So why has it only ticked up from 4% to 4.3%? It's because of how unemployment is calculated in the US. If you're unemployed, but you work for just 1 hour a week, say handing out flyers, you're not considered unemployed. If you quit your job, you're not counted unless you've been actively searching for a new one for a month and failed. Even if you are counted, you only receive unemployment benefits for a maximum of 6 months. After that, if you still can't find a job, you're no longer considered unemployed, removed from the labor force entirely. It's incredibly difficult to push the US unemployment rate up, so a 0.3% increase is actually quite significant. If you want to see the real unemployment situation, just visit a major city like New York, where you'll see countless people living on the streets, many of whom had stable jobs just months before. So what's the truth? US economy may be like a cancer patient, but the Federal Reserve claims it's healthy and just taking vitamins, trying to keep the patient stable and prevent the world from knowing the truth. They dare not admit this is the beginning of a recovery-oriented rate cut, because they know that once the market realizes the US economy has a terminal illness, the dollar will collapse and global capital will flee. They are not taking vitamins, preparing to administer morphine, and the dosage will only get higher as they turn to printing money. Historically, the Fed only prints money during a market crash, when asset prices have hit rock bottom. They lend it to capitalists to buy up assets at bargain prices, pushing prices back up and transferring wealth. About the tariffs. Even if they are ruled illegal, repealing them would be a disaster for the US government. Treasury Secretary Scott Bessent has indicated that if the tariffs were overturned, the government could have to pay back all the money it collected, a sum that could be as high as $1 trillion. Where would that money come from? Government used that tariff money to fund tax cuts for corporations. If the tariffs are abolished, would those businesses have to pay back their tax cuts? It would create a fiscal nightmare. This is why, even if the tariffs are legally questionable, the government will likely appeal and fight to keep them. So, with interest rate cuts certain and tariffs likely to remain, the sacrifice in our trilemma is still inflation. The dollar will continue to depreciate. This brings us back to the crucial question: what is Warren Buffett really doing? He bought $5 billion in stock but sold $8 billion. With US interest rates falling and tariffs still uncertain, is he really bargain hunting in the US market? No. He's making a head fake. He's actually moving assets. He can't move all $350 billion in cash at once without collapsing the dollar, so he has to keep much of it in US Treasury bonds. But his real target is Japan. Why? Think about it. If capital is going to flow out of the US dollar, where will it go? The US government doesn't want it flowing to China. The only other major destination is Japan. This is why the US Treasury Secretary has been urging Japan to raise its interest rates. While the rest of the world is cutting rates, if Japan raises them, money will naturally flow there. And how did Warren Buffett position himself? He borrowed trillions of yen in Japan at near zero interest and used that money to acquire Japan's 5 largest trading companies. The annual dividends these companies pay him are more than 5 times the interest he pays on the loans. He now owns over 10% of major companies like Mitsubishi. When a guru like Warren Buffett endorses the Japanese stock market, global funds follow, driving up prices. He is using Japanese money to drive up the value of Japanese assets. In doing so, Warren Buffett is helping the United States build a reservoir for capital. He's trapping dollars that are flowing out of the US and Japan to prevent them from going elsewhere. So is Warren Buffett's real investment in the US or Japan? This is why, while sophisticated investors are quietly selling off US dollar assets, many retail investors are rushing in. I'm not saying you can't make money in US stocks right now. My team and I also invest in them. But you have to know what you're doing. You're betting on a stock market rebound, even as the broader economy weakens and the dollar depreciates. Our strategy is like guerrilla warfare. We get in, make a profit, and get out. We use strict stop losses and take profit orders because we understand the risk. If you want to systematically learn how to build a firewall for your wealth, I urge you to join our free stock investment masterclass. If some of the details in today's video were confusing, I suggest you watch my previous 2 or 3 videos. The logic is interconnected, and I can't re-explain everything each time. Now for the part many of you wait for each week. What do we expect to happen next? I'll continue sharing free information about building wealth and achieving financial freedom. If you don't want to miss out, subscribe to my channel and turn on notifications. Then please share this video. I sincerely wish everyone who liked this video a speedy journey to financial freedom. If you have any questions, leave a message. If you found just 1 or 2 useful ideas today that can help you, I'll be satisfied. Okay, see you next video.